Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Bonds track treasuries higher in the Asia session as signs of a cooling US labour market see traders bring forward bets for rate cuts from the Fed. Indian Prime Minister Narendra Modi loses his majority in Parliament, forcing him to rely on allies to form a government. The surprise result wiping almost $400 billion off stock values. Plus, here in the UK, Sunak and Starmer face off in the first TV debate of the general election, with the Conservative and Labour leaders trading barbs over their rivals' tax plans. Let's check in on these markets then. Modest gains for US stocks overnight. The focus, of course, on the job openings data coming in below all the estimates that had come through from economists gauged by Bloomberg at levels last seen, the biggest drop, in fact, since 2021 on the job openings picture of the US. You're looking at European futures then, currently up 0.5% because there is this readjustment once again in terms of expectations about the Fed, bringing forward those cut expectations from December to November on the back of the softness that you're starting to see in the US labour market. UK futures pointing to gains of 0.6%, up 48 points. S&P futures pointing to build on the gains of yesterday, the modest gains of yesterday, looking up by 0.2%. Nasdaq futures looking to add 58 points, up 0.3%. Let's flip the board and look cross asset then. Oil is interesting today. Bitcoin also interesting, but we'll start on the US 10-year yield. Yields came in. They dropped 6 basis points yesterday on the back of that data. Yields up just 1 basis point so far in the session, 433. Since the end of May, you've seen a move of around 30 basis points lower in yields. 433 on the US 10-year. Euro dollar at 108. Brent at $77 a barrel. Inventory reports suggesting that stockpiles are growing in the US. $77 currently on Brent and 71,100 on Bitcoin, closing in on that 73,000 record level. Further gains in that major crypto in the session today, gaining a full 1 percentage point. Let's cross over to Singapore now. Avril Hong is standing by for a check on the Asia markets. Avril, what is standing out to you this morning?
Well, those Indian assets are really standing out. But before I take you there, let's talk through what we're seeing in the rest of the Asia Pacific, because after that JOLTS data, we're seeing a mixed bag in the region, and the tech shares are helping to support the Hang Seng, the Kospi, that rate-sensitive sector, as you know, Tom. But the CSI 300 is in negative, as is the Japanese benchmark. We did get some Tyson Services PMI today rising to 10-month high, but failing to impress investors. In Japan, it's those export-related stocks that are drag. Ultimately, it's about how the yen is faring. Still really weak, but we did see, flip the board, 2 days of appreciation in the Japanese currency after soft US data, as well as those expectations that the BOJ is going to start next week to mull the reduction in bond purchases. And we're seeing today that climb from the past 2 sessions, taking a bit of a breather after same sample wage data rose less than expected. So we're seeing the yen still hovering around the 1556 level. Let's flip the board, because as I say, we're really keeping a focus on India today. And this is after we got those election results that really raised concern about the makeup of the government. What is this going to mean for economic policy? What is Modi ultimately going to be able to push through? Yesterday, we saw about $380 billion worth of market cap wiped off Indian equities. Today, there is a bit of a recovery in the Nifty, in the Sensex, but remember, it was about 6% decline yesterday. The yields in India on the 10-year continuing to climb. The rupee is showing slight recovery. We have the likes of Goldman saying the earnings growth story, that still seems intact for India, but that doesn't seem to quite be reflected when we look at the assets in the country today, Tom.
OK, Avril Hong with a market check there, ending on India, of course, and we get more details on that story. Avril, thank you. Narendra Modi vowing to stay on as Indian Prime Minister. We couldn't believe we're saying that. We couldn't believe that a week ago, at least, given the polling. Even after his party lost its majority, parliamentary majority, in a stunning upset.
Today's victory is the victory of the world's largest democracy. This is the victory of unbreakable allegiance put into the Constitution of India. In our third term, this country will see a new chapter of big decisions.
OK, joining me now is Bloomberg's chief Southeast Asia correspondent, Haslinda Armin, who's been live and across this story for us from the outset, joining us from New Delhi. It is a stunning blow, then, to Modi, Haslinda, and potentially to his policy agenda.
Well, you're right. The largest democracy in the world, the people saying no to status quo, yes to change, and some calling it perhaps a political earthquake. Now, Tom, this is how the knife fell, right? We had Modi's BJP party garnering 242 seats. It is the party with the largest number of seats, but no, it didn't get a one-party majority. It needed 272. Now, what happens now? Modi will have to lure the two-party alliances in his alliance, in his coalition. The problem really is this. They're kind of like flip-flopping all the time. In fact, the two parties joined Modi's alliance only several weeks ago. So we're still unsure if Modi will be able to convince them to join him, or if the opposition may be able to peel them away and get them to join the opposition. So therein lies the problem right now, the uncertainty, how this might play out. We've been talking about how, yes, there's some certainty that perhaps Modi will form the government, but no, a week from now, we're not too sure yet if Modi remains the prime minister of BJP, is able to form that majority in parliament. And we've seen the flip-flopping in the markets as well. We saw that 8% drop, as much as 8% drop in the markets today. When the markets opened today in India, it was in a positive, and then it dropped again. Therein lies the uncertainty, and markets not comfortable with what they're seeing right now.
Yeah, indeed, the dramatic rout that we saw in Indian stocks, of course, yesterday, and very little being done today so far in the session in India to make up for that. Very, very modest gains so far on the Nifty 50 and the Sensex. What does it mean in terms of the policy agenda and the uncertainty then going forward for this potential Modi government?
Well, it all depends who eventually comes to power. When you talk to a lot of investors here, they expect in the short term for policies to remain intact. Remember, we talked about how the stars are aligned for India. We have 8% growth, the fastest growing G20 country out there. We have S&P just about to upgrade the credit rating of India in the next 24 months. We have a demographic dividend, 80% of the population below the age of 35. There is a lot going for this country, and that growth is expected to be maintained, especially with the spending plan that Modi has put in place for the next 2 years, amounting to more than $500 billion. The question is whether those hard and controversial policies like labor, like land, they're really controversial, whether they can be pushed through. These are difficult policies to implement. That's why Modi was looking for that supermajority to push it through, but that remains to be seen. But you know what, Tom? In the end, it is the people that matter. This is a country that has 200 billionaires in the world. It is the third highest number in the world, behind only the US as well as China. People want more. People want more from Modi. The policies so far have not translated to wealth for the common people. That is what he needs to address.
Yeah, that wealth divide pronounced. Bloomberg's chief Southeast Asia correspondent, Haslinda Armin, live for us in New Delhi with the context and continuing analysis around, of course, that dramatic result out of India. Haslinda, thank you. Now to the UK election campaign, where Prime Minister Rishi Sunak and Labour's Keir Starmer clashed over taxes in the first TV debate of the campaign.
We will raise specific taxes, and we've been really clear what they are. We've already dealt with the tax break on private schools. We want to end the non-dom status completely. I think that the super rich should be paying their tax.
Independent Treasury civil servants have costed Labour's policies, and it's £2,000. But you asked the specifics, Julie. So let's have a specific difference.
Please let
I've
Mr Sunak
announced
finish.
The triple lock plus, so that we raise the personal allowance for pensioners and ensure that the state pension is never subject to tax. That's what you'll get under a future Conservative government. Keir Starmer hasn't matched that pledge, which means for the first time in our country's history, if Labour are elected, pensioners will pay tax. I do not think that is right.
OK, let's get more then with Bloomberg's UK correspondent Lizzie Burden. Lizzie, top line, who won?
Well, the Prime Minister wanted this to be about tax, and you heard the sound bites from both of them there. He made it about tax. The YouGov polling afterwards showed that Sunak came out 51%, Starmer 49%. So that suggests Sunak won this debate. Starmer's response, as you heard, to this tried and tested Tory tactic of maintaining Labour as the tax raisers was to say it's garbage that Labour would raise Britain's taxes by £2,000, but he didn't seem to land that rebuttal, hence why Labour rushed out a press release afterwards explaining it in more detail. But even if Sunak managed to get this point across in the debate, it cost him likeability. And this is the point for the broader vote. Look, we had a Survation poll right before they went on the set showing that Starmer is going to win the biggest landslide in political history. So a 2 percentage point lead in the post-debate polling is not potentially going to be enough to move the dial. And as you always remind us, Tom, it's the scores on the doors on July the 4th that really matter.
Well, yeah, I mean, certainly the Conservative Party would say that, wouldn't they, given the polling gap. And arguably there was more for Rishi Sunak to gain in this TV debate than Keir Starmer, given that gap. Is it your takeaway that he did land any significant blows, or in fact that Starmer landed any blows on the Prime Minister? You've said that it's probably not going to move the dial, but is there anything that we can take away from this that might feed into how we view the campaign going forward?
I will say I stayed up to watch this, Tom, so you can excuse the eye bags this morning. The biggest audience groan was directed at the Prime Minister, and he got the biggest laugh at his expense. And this was a moment when he tried to say that National Health Service waiting lists had come down. He made a bit of a gaffe over that, giving Keir Starmer the opportunity to say, I thought this was the guy who was good at mathematics. Look, Starmer's main message was that after 14 years of Conservative rule, Britons want a change, that it's these 14 years of underinvestment in public services that have left them creaking. And indeed, if you look at the polling, most Brits do expect taxes to rise to boost infrastructure, and polls suggest overwhelmingly that they want Labour to do it. It made it more poignant when both of them were asked, would you use private healthcare if a loved one was on a waiting list for surgery? Sunak said yes, Starmer said no, but it's an easily cut-throughable line that is perhaps what will be most memorable for Brits this morning.
OK, Lizzie Burden, UK correspondent on that TV debate. I believe there's another one towards the end of this month as well, between the two leaders of the Conservative Party and the Labour Party. Thank you very much indeed, Lizzie. Let's get to the economic data out of the US then, because there were market moves on the back of this. The latest US labour market data fueling Fed rate cut bets. Yes, we're back there. Swaps now fully pricing in a November move. Previously, it was December. That's after US job openings fell to their lowest level in 3 years. For more, let's bring in our Markets Live executive editor, Mark Cardmore. Mark, we've gone from an environment where we were hearing what were deemed to be relatively hawkish Fed comments from Fed officials to data that seems to be lining up soft for the US, whether it's on the consumer, whether it's on manufacturing, now the job openings. We've seen the movers in the Treasury markets. What is your take in the market interpretation of this data from the US?
Yeah, good morning, Tom. It's really disappointing, but I think the market pricing's kind of right where it is right now. Obviously, it's much more interesting if there's a bit of a view which way it can go, but I think one rate hike by November is a roughly fair equation of the balancing of the odds, the fact that, hey, the growth was looking really good until a couple of months ago, inflation's still sticky, and suddenly we've had a few softening prints out there, and therefore we don't really know about the trajectory for now. We've got a lot of uncertainty. We could be in a path where suddenly growth is actually going off a cliff, and we could be suddenly talking about several rate hikes by year end, or this could just be a few misleading numbers. We know the ISM has not been a very good guide in the last couple of years. There's been increasingly negative bias in that print, and the hard data has not backed it up. So there's a chance that maybe these prints are misleading. The economy will be fine. I think that this Friday's non-farm payrolls data will be really important, and much more important than yesterday's JOLTS data. We've talked about this a lot over the last couple of years in the show, Tom, but the idea is that JOLTS data is good for the big macro backdrop. And while we could say at one point that job openings dropped to the lowest since 2021, another way of putting it is they're the highest in any period in history before 2021. So basically, the whole paradigm changed post-COVID. We're starting to normalise. Those job openings are falling from a high level, but there's still more job openings than unemployed people in the US, which is something that we just didn't seem to think was possible 10, 15 years ago when I first started looking at these numbers. And it's also a data point from April. So JOLTS is good for the macro backdrop that this is a hot jobs market cooling rapidly, but still on the warm side in kind of that economic metaphor. But it's not the best for identifying turns in the jobs market. For that, it is initial jobless claims is the best, and non-farm payrolls is good for a broader number.
OK, so we look ahead to non-farm payrolls on Friday. Before we get there, we have the ECB decision, Mark. And as you know, consensus is they go with a cut. But it's the commentary and it's the guidance going forward that it seems investors will be scrutinising. One of the Bloomberg stories on the terminal today, the title, the headline is ECB's inflation challenge looks more and more like the Fed's. Does it?
Yeah, a little bit, in terms that, sticky inflation is global. So the services side we always knew would be kind of sticky. What's happening now is that the volatile goods component is come out of the disinflationary cycle and is back in a reinflationary cycle, fueled by the fact that commodity prices are rising, shipping rates are rising. So I think the ECB is suddenly more worried about stickier inflation above its target level, even though its growth is not as strong as the US. And that's why a lot of people, including most of my team, think that the ECB will kind of emphasize a dovish narrative this week, and therefore the market can price in more rate cuts. I'd say that's the consensus out there. I'm slightly worried that the ECB might take a note from the Fed's playbook and really go back to emphasizing data dependence, that they're open-minded about the path from here. And that'll be disappointing to all those who are looking for fresh rate cuts to be priced into the curve in the ECB.
OK, really interesting as we look ahead to that decision from the ECB. Bloomberg's Markets Live executive editor, Mark Cudmore, with the analysis. You can get a roundup, of course, of the stories you need to know to get your day going in today's edition of Daybreak as well. Worth flagging to you, terminal subscribers can go to DAYB Go to get the details on those stories, including really fascinating story around BlackRock, Citadel and some others funding a new stock exchange in Texas. We're also looking at, of course, the expectations around the Fed and pricing there from traders, and the details as well around Intel selling a stake in one of its businesses in Ireland, worth about $11 billion US to Apollo. By the way, later on this show, we're going to be speaking to Apollo Asset Management co-president Scott Kleinman about that deal. That is going to be a fascinating conversation, so do stay tuned for that. That's going to be live with us, 6:30 a.m. UK time. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Hamas has followed Israel in balking President Joe Biden's efforts to end the war in Gaza. Both sides saying their conflicting conditions for a permanent ceasefire must be met before they'll even agree to pause fighting. Let's get the details then and an update with Bloomberg Horizons anchor Jumana Pasecci, who, of course, has been following and continues to follow all the twists and turns of this. Joining us out of Dubai. Jumana, what is the latest then on this Biden ceasefire proposal? Is it falling apart?
The officials' pushback against this Biden proposal that was put forward on Friday, many within Israel not liking the terms of the deal, particularly in light of that commentary surrounding that longer-term ceasefire. And it seems now we're getting a response from Hamas, too, with senior Hamas officials saying that they're not going to agree to the terms of the deal unless Israel give an official stance. And the sticking point, as we spoke about yesterday, is that Israel would like to see Hamas completely out of the picture before agreeing to talk about what the future of Gaza looks like and that permanent ceasefire. Now, in the interim, the mediators, Qatar, have said that they're also waiting to get an official Israeli response that would highlight some proposal that would be acceptable to all members of the Israeli coalition government. And as we spoke about yesterday, many within the Israeli coalition government would like this war to continue with the sole aim of neutralizing Hamas. At the same time, Tom, there was an interview given by U.S. President Biden to Time magazine on Tuesday, and he was asked whether Netanyahu's political considerations were driving the war, to which Biden responded, there is every reason for people to draw that conclusion. Those comments have been met with a lot of backlash in the last 24 hours. President Biden has now tried to backtrack as well from that, saying that Netanyahu has to work out a very serious problem. But that again underscores a lot of the sensitivities around these discussions, in addition to some of the sensitivities right now between U.S. and Israel's, of course, closest ally, as we talk about pushing forward those ceasefire discussions. But for the time being, it appears that both sides, Israel and Hamas, are not feeling confident about where these peace talks are going.
OK, Bloomberg Horizons anchor Jemana Besetchi, thank you very much indeed on the latest out of that region. Coming up, the leader of South Africa's Democratic Alliance Party says he does see room for a coalition deal with the ANC. More on that next. This is Bloomberg. Welcome back. Happy Wednesday. Let's turn our focus now to the latest on talks in South Africa to form a new government. The leader of the main opposition, Democratic Alliance, says investor optimism about a coalition deal with the ANC is not misplaced. Let's get more then with Bloomberg's Jennifer Dabasaja, who joins us out of Johannesburg. Jen, what are the outstanding obstacles then to a potential tie-up between the DA and the ANC?
Right, Tom. I mean, I think we have to just look at really the historical relationship between these two parties, and they have largely been opposition parties. So there are still a number of obstacles that they need to get through, not just on the ANC side, but also John Steenhuisen was telling us even within the DA, they still need to talk to their own party members about really how to move forward. But the time is of the essence, and we talked to John about that, really just about how important it is for South Africa to get back on a higher growth trajectory. But, you know, he made the point to say that, yes, that is important for all parties and really for South Africa. But there are some red lines. So when we talk about the concessions and the demands that may be a part of these negotiations, John outlined just from the opposition party perspective what the red lines are. Here's what he told us.
We don't believe in expropriation without compensation. So if that is on the table as a policy, it's a red line for us. Sticking with NHI in its current form would be a red line for us. We believe the bill needs to be amended to include choice back into it. I think we can have universal access to basic health care, and I think there's a conversation that can be had about how best to achieve that.
Right. And Tom, you know, John went on to talk about really how the choice now that we are trying to figure out what this minority government is going to look like, the choice based on his perspective is between pro-market or anti-market parties. So he's talking there about some of the policies that they stand for. But really, you know, we got some insight on Tuesday into just how important this is. We saw the first quarter GDP here in South Africa, the economy contracted, and we heard from Fitch, the ratings agency, that said the outcome from the election raises new risks for South Africa's credit profile. So it's really important to pay attention to really what these negotiations behind closed doors are happening and what it will mean moving forward for economic policy for this country.
OK, Bloomberg's Jennifer Dabasaja in Johannesburg on the importance of those coalition talks in South Africa and the significance for the markets. Jen, thank you very much indeed. Stay with us, by the way, for extensive coverage of the South African elections on Friday. We're going to speak exclusively to the economist and political analyst Moeletsi Mbeki. That's in Africa Amplified, our monthly deep dive into Africa's political and economic landscape. Coming up, it is the conversation of the hour. Intel agreeing to sell a stake in its Irish chip-making venture to Apollo for $11 billion. Scott Kleinman, co-president of Apollo Asset Management, gives us his first interview of the day. We'll be talking about that deal. That is next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Bonds track treasuries higher in the Asia session as signs of a cooling US labour market see traders bring forward bets for rate cuts from the Fed. Indian Prime Minister Narendra Modi loses his majority in Parliament, forcing him to rely on allies to form a government. The surprise result wiping out almost $400 billion of stock value. Plus, Apollo makes an $11 billion bet on semiconductors, agreeing to take a 49% stake in a new Intel plant in Ireland. We will be speaking to Scott Kleinman, Apollo's co-president, in just the next few minutes. Before we get there, though, let's briefly check in on these markets. Yes, the Treasuries rallied yesterday, yields down 6 basis points on the 10-year, up just 1 basis point so far in the session on the JOLTS data, the job openings data, that saw the biggest drop in about 3 years, suggesting there is softness coming through for the labour market of the US as we look ahead to non-farm payrolls on Friday. European futures pointing to gains of 0.5%. Again, expectations for Fed cuts being brought forward from December to November. The FTSE 100 looking to gains of 47 points. S&P futures looking to add 10 points, up 0.2%. Nasdaq futures looking to add 60 points, up 0.3%. Let's flip the board and look briefly cross-asset. We talked about the rally in the bond market. There's a very modest easing in that rally so far in the session. 434 on the benchmark 10-year, 108 on euro dollar, $77 a barrel on Brent, and Bitcoin just below $71,000 per coin, just up 0.8% so far in the session. Let's get back to that fascinating story around Apollo and Intel. The deal then, Intel agreeing to sell a 49% stake in a venture that controls a chip-making plant in Ireland to Apollo Global Management. The $11 billion deal bringing in more funding for Intel's massive expansion of its factory network. For more, let's get to Bloomberg's briefs anchor, Danny Berger, who is at the Super Return Private Equity Conference in Berlin. Danny, what a pleasure, and you have a fantastic guest standing by on this story. Danny.
I do. The guest that you'd want to talk to on this story, I'm very pleased to say that I'm joined by Scott Kleinman, co-president of Apollo Asset Management. Scott, thanks so much for joining this morning.
My pleasure, Danny. Good to be here.
I mean, we have nothing to talk about. What a shame. Exactly. So, look, this is a big deal. $11 billion. It does feel a very Apollo-appropriate deal, but it is something a little bit different than what you usually do, perhaps in size and the type and industry it's in. So how hard was this deal to do? What did it take to get it over the line?
Sure. Well, look, I think you're seeing, if you take a step back, companies all over the world are facing unprecedented levels of CapEx, right? Digitization, deglobalization, energy transition. And they're starting to think more creatively about how are they going to fund this? How are they going to fund this capital? And private capital is going to play an increasingly important part of that. The Apollo platform, $700 billion, equity, credit, hybrid, lots of different creative structures, and the ability to scale it. These type of blue chip, large cap companies, they're not talking about 100 million or 500 million. They're talking 2 billion, 5 billion, 10 billion plus. And so the ability to really come up with those creative solutions in scale is really, really critical. But I think you're going to see more and more of this coming because absolutely more from Apollo, but in general, just the need for this type of capital is insatiable.
Right.
Really insatiable.
We saw in the earnings report, right, all these tech giants having an insane amount of capex to try to get their AI capacity up. Intel obviously is one of them. They did, though, say that their manufacturing won't be profitable until 2027. So how much of this also is not just Apollo backing AI, but Apollo backing Intel for the long term?
Absolutely. This is all about partner selection, structuring. Every situation is going to be different. That's the beauty of private capital. It doesn't have to fit one single box. You can really be creative to meet the needs of the project, the needs of the counterparty. And this is just a great example of how you're going to see more and more of this. Yeah.
Well, if you're going to see more of it, I mean, does Intel need more? They're trying to take a crack at NVIDIA. That is no easy feat.
Right. Well, I think Intel's announced over $150 billion of projects. So that's just one of, I think, many companies across lots of different industries that really need this type of capital.
Are you talking to other companies, too, besides Intel for this type of thing?
Well, no comment, but you can probably assume.
Well, just the last thing on this, Scott, because, I mean, we are here in Europe. This is a Europe deal. It's a plant in Ireland, and Europe has been behind on manufacturing. Is there some way that this is almost a test tube, that's a test trial, and if this works, maybe you do more in Europe like this?
Well, I think just zooming out a little bit, I do think you touch on an important point, which is if you compare the growth rates in Europe versus the growth rates in the U.S., obviously it's undeniable what's happening. A big part of that is companies' access to capital. Right, in the U.S., in addition to the banking system, you have a very robust capital markets, a securitization market, a very deep private capital market. In Europe, all of those things either don't exist or are very, very small, very fragmented, very nascent. And I think you need to see more and more of this, and you will start to see private capital play a bigger role here in Europe.
It's a tougher environment, though, because there does feel to be more regulation here. So how does that impact your global allocation, that there's opportunities here, but they're a little bit harder to execute?
Well, it just makes it more complicated, but you're seeing it. I think European leaders are starting to recognize that Europe is choked for capital, that is limiting the amount of growth, that Europe is falling behind, and it needs this type of capital. It needs to encourage private capital. It needs to encourage securitization in order to make that happen. And, I know Europe's been talking about it for a while, but, hopefully this is a bit of the wake-up call it needs to get going.
There's also a rate divergence story happening in about 24 hours, about 300 miles from here in Frankfurt. We'll get what presumably will be the first cut of this cycle from the ECB. Does that make a difference to you at all, that maybe there's easier policy here?
No, I think that's more indicative of the need the economy needs to get boosted by, I'd say, artificial lowering of rates, as opposed to the U.S., where we've been saying for some time the economy is so strong, rate cuts probably don't make sense yet.
Right. Do you think that there's some people in the U.S. then that just have been doing the extend and pretend, that they bought deals at high valuations and have just been hoping for a rate cut? So what happens if we don't get one this year and maybe only a few next year?
Oh, I think that's absolutely right. I think the reality of this, and I think it's the morning of the conference here, but I think you're going to see a lot of GPs and LPs coming to the recognition that it's going to be a pretty dry spell for the next few years vis-a-vis the old portfolio of private equity companies. It's going to take longer to monetize. The valuation gap between where folks loaded up on deals versus where the market is today is there's a big gap, and it's going to be, I think, a little bit tougher for private equity firms to see the type of returns that they were looking for versus years past.
What does that actually look like? What causes that dam to break? And then what does it look like when it does?
Yeah, I don't know that it's so much a dam. I think the reality is private equity loaded up at the top of the market using very inexpensive debt. Valuation environment has fundamentally changed. And as a result, private equity sponsors are just going to have to hold companies longer, have to grow into those capital structures, are going to need to take on equity to get some refinancings done. And all that means, it's just math, that returns are going to be lower over the next few years.
Well, I'm sure LPs, investors who hear the idea that they need to hold on for companies longer are not going to be happy with that. They've been clamoring to get their cash back. So how do they do both at the same time?
They generally don't. I think you're going to see sponsors looking for creative ways to return capital, whether that's through structured equity investments or other things into these portfolio companies. But eventually, sponsors are just going to have to accept the valuation environment is lower and start selling companies.
So are you getting ready to buy some deals? Are you getting ready?
Absolutely.
Are you hiring to match that?
No, we have a pretty robust. We have several hundred people already here in Europe, and feel like we have a good footprint. Yeah.
Okay, so you're ready. You're ready for the deals of what they come.
Absolutely.
What kind of valuation discounts do you think we're talking? How hefty could they get?
Well, I don't think it's so much discounts as it is the current environment is just repriced. Folks, when deals are purchased at a 0% rate, that implied a valuation environment of X. At a 5% rate, risk-free rate, that valuation environment is lower. And whether marks reflect that or not, TBD, but the reality is it's coming.
And, one of the venues for exiting historically is pretty much closed. It's been iced over. That is IPOs. Unless you have maybe a really robust tech company that you can IPO, it's a really hard environment. But it's kind of counterintuitive because stocks are at an all-time high. You'd think that the IPO market would be back. So if it's not back now, has something fundamentally changed?
Absolutely, Danny. I think you're really onto something here. The equity markets have fundamentally changed, right? Because of the massive increase in indexation in passive market participants. Right, the market doesn't care about a $3 billion IPO, a $5 billion IPO, and that's forcing sponsors to also think about well, how do you exit, right? Because unless you're prepared to just exit at a mediocre valuation in the equity markets, you're going to need a different path to exit. And I think that trend is only continuing. I mean, look at the U.S. equity market. 10 stocks represent a third of the S&P, probably 2/3 of the gain over the last year, right? That's just indexation at work, just more and more dollars flowing into the biggest stocks. And that's tough. That's tough for small companies.
You sound a little bit like David Einhorn. He's also said that fundamental companies can't get a break because of just the price-insensitive buyers. So what is the good option? You say other ways to exit, other ways for liquidity. Take me out, 5-10 years from now, where the IPO market, we've decided that this is no longer an option except for a few slim companies. What are people doing instead?
Sure. By the way, I'll answer that in a second. But it's that very disconnect that actually makes public to private is very interesting right now. Yes, the S&P looks like it's hitting all-time highs, but you have a third of the companies in the S&P whose stock is down year to date, right? That's just not reported on. That's not what people fundamentally know. But there's a lot of interesting companies at reasonable valuations out there. To answer your question, though, where do you go with this? This is all the more reason why purchase price matters, right? If you buy companies at reasonable valuations, you're not beholden to premium valuations on an IPO in order to make your returns, right? You can still go public. You just may not get that super premium valuation you thought. Or, you're selling to a strategic, you're selling to another sponsor, you're recapping. There's lots of ways to do it, but it can't be dependent on, well, I'm just going to get out at a premium perfect valuation.
God, it's a whole new world. Totally. Thank you so much for joining. Really appreciate your time. Tom, that's Scott Kleinman, co-president of Apollo Asset Management. Everything for you there, from AI to IPOs.
That was fantastic. Bloomberg Brief anchor Danny Berger at Super Return. Danny, thank you. Lots more big hitters joining us, by the way, from Super Return throughout the day. David Hirschman, co-head of Permira Credit, Angel City FC co-founder Cara Nortnam, Morgan Stanley's David Miller, and Scott Sperling, co-CEO of THL. So do stay tuned for all of those conversations. In terms of breaking news, some earnings crossing from Inditex, the owner, of course, of Zara, listed over in Spain. It's a beat in terms of first quarter earnings before interest and tax, coming in at 1.64 billion euros, above the estimates of 1.61 billion euros. Interestingly as well, sales at constant FX rate between May the 1st and June the 3rd up 12%. Some analysts had only seen growth of 8% or thereabouts. So that's a beat in terms, or at least on some analyst calls, in terms of the sales picture, up 12% over that period. Again, in terms of earnings before interest and tax, it's a beat coming through for Inditex in the first quarter. Other breaking lines coming through from SoftBank as well. This is interesting. Elliott apparently rebuilding a stake in SoftBank, pushing for a buyback. That company listed in Tokyo, the stock price jumping on the back of this report, currently up 5% on the back of this. The details then, Elliott building this stake in SoftBank. The stake is worth more than $2 billion according to reporting from the Financial Times. And they are again pushing Elliott, the activist investor, for a buyback worth as much as $15 billion Again, according to reporting from the Financial Times. The stock rallying over in Tokyo on the back of that news. We'll get more details on that in the hours ahead. Coming up, European Parliament elections are getting underway tomorrow. We're going to look at how the war in Ukraine and the threat from Russia is playing a part in that vote. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, President Joe Biden is planning 2 meetings with Ukraine's Volodymyr Zelenskiy in the coming weeks. The US leader is seeking to telegraph solidarity with Kyiv in its war against Russia, despite plans to skip an upcoming peace summit in Switzerland. The president will meet Zelensky later this week in France on the sidelines of the 80th anniversary of D-Day in Normandy. A second meeting is planned the following week at the G7 summit in Italy. Meanwhile, voting getting underway tomorrow in the elections to the European Parliament. In the continent's east, with the threat of Russia close at hand, security has played a central role in the campaign, including, of course, in Poland, the region's biggest economy. At this point, let's get the analysis then and bring in Bloomberg's Piotr Skolimowski with the details, who is in Warsaw. Joins us now. Piotr, how big then, how central a role is the security question playing in this election, particularly for Eastern European countries across the EU?
Hi, Tom. So indeed, that's the central question for especially Eastern European countries in the EU. So we're talking about Poland, but we're also talking about the countries of the Baltic states, so Estonia, Lithuania, and Latvia. In Poland especially, security has been the main topic that Prime Minister Donald Tusk picked up on. He sort of cast himself as the gatekeeper of Europe. He has warned against the threat of sabotage from Russia and Belarus. There's also, and what we're seeing over the recent weeks, there's a pickup in a number of migrants who are illegally trying to force their way through the border with Belarus, so from Belarus, and they are being flown into Belarus from Middle East. So the centerpiece of the campaign for Tusk has been that he's going to build what he called Shield East, which is fortification on the border. They're planning to invest about $2.5 billion in that fortification. So the sense is the government is there to protect the border and the security, and there is a risk of sabotage from Russia in this election. And obviously for Tusk, it's important, and it's actually a change in his narrative, because he has very much been portrayed as weak on defense by the opposition, which he kicked out of the government in the general election in October. It's the third election over the last 8 months in Poland. So there's a sense of fatigue, and Tusk is trying to energize his base, and he has been very blunt about it. He basically said, if you don't want to go to war, go vote. And that message is there, and he's trying to reinforce that this is a very crucial election for Poland and for Europe as a whole.
And if we look to Poland's borders and we look at Hungary, to what extent Hungary and, of course, Orban and his government and the hold-up of funds, to what extent is that a risk for investors? And how is the politics, how is the election likely to play in to the role that Hungary plays, particularly when it comes to aid for Ukraine?
Yes, indeed. So in Hungary, actually, the election is quite interesting in that sense, because it's both European Parliament and local election. But for the first time in a very long time, we are seeing that Prime Minister Orban is facing a challenger. It's a guy called Peter Magyar. He used to be sort of the administration insider. He used to be a diplomat with the administration of Viktor Orban, and suddenly, a few months ago, he turned against them. He became something of a whistleblower for the administration. He went after Orban. He kept talking about the corruption and the weakness of the economy, and suddenly this guy was catapulted into a main challenger for the leader who has been in power for 5 terms right now. So for the first time in a very long while, Orban is having a challenger. He's obviously in conflict with the EU. There's money that's being blocked, and Magyar has been pointing out that obviously something has to change. He's not going to win this election for sure. I mean, his party that he actually is leading right now is going to probably receive about like six seats in European parliamentary elections, 4 out of 21 that are going to get there. But as a matter of fact, Orban is facing a challenger for the first time, but he's still trying to portray himself as the one who is making sure that there is peace. That he told his supporters over the weekend in a rally in Budapest that he's the only government, he's on top of the government, the only government in the EU that is making sure that Europe doesn't go to war with Russia because of his sort of because he doesn't support aiding Ukraine. But obviously that's causing a lot of concern among the leaders in EU. He's holding up aid. A lot of them, especially from the countries in the Baltics, are raising concerns. They are really worried about this, and they're making that hurt.
Okay. Piotr, thank you very much indeed. Bloomberg's government and economy editor for Central and Eastern Europe. Piotr Skolimowski, thank you. Now, over in Spain, a judge has summoned the wife of Prime Minister Pedro Sanchez to testify as the target of a criminal investigation. Begoña Gomez will have the opportunity to respond to questions next month as part of a broad inquest into alleged private sector corruption and influence peddling. The Spanish government says the allegations are unfounded and part of a broad right-wing attack against the Prime Minister. Novo Nordisk is Europe's most valuable company with booming demand for its blockbuster diabetes and obesity drugs, Ozempic and Wegovy. CEO Lars Frøgaard Jorgensen spoke to Bloomberg about the cost of its medicines and the difficult questions the company has faced from various governments.
Most products are priced according to the value they bring. And I feel really good about the value of our medicines, what they bring to the individual patient, but also the value to the healthcare system. And we have today healthcare systems around the world who were typically designed for acute care, but finding that 80% of the cost in the healthcare system is linked to chronic care. And we have a portfolio of products that are really addressing some of the chronic diseases of our day and age.
OK, and you can see that full interview on Leaders with Lacqua airing at 9:30 p.m. New York time tonight in the US, then at 6:30 p.m. London time on Thursday. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Wednesday. Let's check in then, give you some context in terms of the moves of flood of money into the Treasury markets, if it's a flood. Is this the opening stages of a bond rally, a pronounced bond rally, or is this a fake in terms of expectations around where the Fed goes? Because you've seen yields down about 30 basis points since the end of May until this point now. You're around 434 on the US 10-year. 430 is a line that's closely watched. If you break through that, you could be looking at a range of between 4 and 4.2%. Again, this being built on the expectations. The data's been coming out softer from the US, whether it's manufacturing or the consumer, or, of course, yesterday, the job openings data falling the most in close to 3 years. And that has readjusted and repriced in terms of the Fed. Expectations being pulled forward from December to November. And, of course, you're seeing the effects in terms of money flows into US Treasuries. Again, this is the level to watch, 430 on the US 10-year. There's plenty more coming up. The macro conversation will be part of it, and deal making, of course, with guests joining us from Super Return throughout the day. A strong list of big hitters, including David Hirschman, co-head of Permira Credit, Angel City FC co-founder Cara Nortman, Morgan Stanley's David Miller, and Scott Sperling, co-CEO of THL. But before we get there, plenty more coming up on markets today, including some of those conversations. This is Bloomberg.